Hello and good morning, friends. Myself, Shumoy Goswami, and I am welcoming you all on behalf of Proficient in our weekly webinar. It is 8th of September 2018 today, and Saturday. And today we will be discussing about some academic issues. Unlike other weeks where we have discussed various aspects of the market, right now we think market is in overall bull phase. So unless 11,325 region is broken, nothing much is needed to be said about the market. We have to keep a stop loss and buy on weakness. So that's about the market view. But this week we have decided to give you an overall view of how to do stock selection, right? So this is our today's topic. We will be talking about various methods of stock selection, not various methods, mainly the approach we follow here. Initially, the process begins with some philosophical approach. That means, what is your basic logic of how market behaves? Are you a trend follower? Do you like to trade volatility breakouts, or you are a mean reversion trader? So there are various aspects, and these are where we should begin from. We approach the market from the perspective of following the trend, right? We are not trying to predict whatever is going to happen in the market, right? Our models are not predictive ones. Our models are mainly reactive ones. We react to whatever happens in the market. We decide what is the trend, and we act on that premises. If we believe trends are up, then we try to find out outperforming stocks. Those are likely to rise more than the market is rising. If we believe the market is in a downtrend, there are definitely various quantitative measures to take this decision whether market is really in an uptrend or not. Nothing is on your perception. At least this is the way it should be, right? You should have various technical parameters that will give you objective answers whether the market is in a bullish phase or in a bearish phase. The thing is that more objective is your system, more definitive is your system. There is, I'm not saying that cannot be wrong, that can well be wrong, but at least you will know where your decision is going wrong and you can rectify that. But if your decisions are subjective, if you decide as the situation is, then you yourself will not know what your reaction will be in a given condition. So we strongly recommend objective approach, and it is because of these objective approaches, because of these definitive rules that will give you the answer whether the market is in an uptrend or in a downtrend. There are various parameters, moving averages, oscillators, and a lot more, right? Patterns, series of bottoms or series of tops. You can look at the series and take an objective decision. So the first most important criteria when you are trying to decide which stocks should be bought or sold, the most important parameter is what is the general trend of the market, right? And as I told you earlier, if you believe the general trend in the market is bullish, then it is safe to trade the outperforming stocks. Those are likely to rise higher than the Nifty in case the bull market continues. And if it is really a bull market, then a safe approach is not to trade any stock from the short side, right? Yes, it is possible that many stocks will underperform even in a bull market, even in a strong bull market when Nifty makes new highs, many stocks will be making new lows. That is another issue. But these picking those trades, we believe, are more risky than going with the general trend of the market. So one of the major premises that we follow as a trend follower is that we will trade in the direction of the trend, right? If the market is bearish and our technical parameters suggest that it is a bearish market, and maybe uh, prices will make lower tops, or prices will be below important moving averages. Market breadth, we can also consider market breadth. So all these definitive indications, if give us the signal that the market is bearish, then in that case we will not look for the outperforming stocks to buy, but in that case we will look for underperformer stocks. Those stocks, those are likely to fall more than the Nifty itself, right? We will prefer to trade those stocks from the short side, and this is how the objective of trend following is achieved, right? Now there is one more aspect that I would like to tell here is that we are unnecessarily concerned with always, or most of the time, and most of us are unnecessarily concerned with success ratio. Success ratio means how many trades are profitable and how many trades are losing in a trading in a given sample. But one thing I can tell you that it is possible to be net profit even after 60 or 65% or even 70%, 75% trades are losing, right? This is exactly what happens in a trend following system. In a trend following system, whenever we have to take a position, most of the breakouts will be false, right? Right now I'm going to show you one such example. The characteristic of any trend following system is that it will have a greater number of losing trades than the winners, right? Greater number of losers than the winners. But that does not mean that the system is worthless. The system can earn net profit even after greater number of losing trades by means of a higher winning, higher average winning. Suppose I have only 40% winning trades and 60% losing trades, but I win 3 times in my losing trades, right? Then I lose in my losing trades. Then I'll be net profit. So for example, I have 40 trades winning among 100 sample, and in those 40 trades I am earning rupees 3 each, right? So I'm earning how much? Rupees 120 in those 40 trades, and in those 60 trades where I'm losing, there I am earning losing only 60 points, right? 1 point each. So net I am profitable by 60 points. So that is how the whole game is played, right? Risk management is of paramount importance than stock selection. Your stock selection may be wrong, or your stock may not move as per your expectation. That is always given in this form of trading, and it is the risk management where we can expect to earn more profit than we lose in our losing trades, and as a result we can be in a profitable position after a large number of samples. So that is our objective. We are not concerned with 1 trade or 2 trades or 5 trades or even 10 trades, because anything can happen in short term, right? I do not know what is going to happen next, neither in the market I do not know how Nifty is going to behave next, and nor in my next trade or next 5 trades. It is possible that next 3, 4, or even 5 trades or 7 trades, 10 trades can go losing. That is possible. That is quite possible. Sometimes it will happen, right? And it can be proved mathematically that if I have a system which gives me 40% profitable trades and 60% losing trades, that doesn't mean in every 10 trades that I take there will be 4 profits and 6 losses. That is not the case. The distribution of profit and losses are random, right? And there are some unexpected strings, long strings that can occur both in profits and both in losses. We have to understand this long-term probability before we employ such trading strategies or any trading strategies as such. So for example, I'm giving you an example where my 40% trades are profitable and 60% trades are losing, and in such cases it is quite possible that sometimes down the line I will have a series of suppose 10 or 12 or even 15 losing trades. That is quite possible. That has some mathematical possibility, and it can be proved that it is possible after some 10 or 15 losing trades. That is possible. And even then, the system is quite legitimate. The system should be continued, right? But you have to take preventive measures for those kind of situations, and that is where risk management comes into play. It is the risk management that will save us in the long term, that will see us through during bad times, right? So stock selection as such is less important, and risk management is more important. What do I mean by risk management? Risk management means how much are you willing to risk in individual trade of yours, one single trade of yours, and at any point of time, how much of your entire portfolio is at risk. These are mathematical questions that has to be answered, and these will give you, if you can answer this properly through proper backtesting of your strategy, then these answers will give you certain age, right? And these ages will generate profits for you. What do I mean by age? Age means there is only a probability of happening something over another, right? That is the age. You need to have some age in your trading system, and if you know how risky your individual trades are, and how much you can lose maximum in your account at any given time, and how much time it will take to recover that losses, how many trades it will take to recover. All these questions can be answered from proper backtesting, and that will give you an age. And you will see from your sample that there is quite possible that there are some long streaks of losers and also of wins. Long streaks are common in nature, right? And you have to take the bigger picture, and you have to accept them. Both is possible, long streaks of losers and long streaks of wins. And this is how the whole game is played on. So anyway, let us confine ourselves into today's discussion, and today we will talk about a method of stock selection that we follow in our own trading. So basically, we are trained followers. We are not trying to predict what is likely to happen next. We are followers. We are reactive. We react to whatever is happening in the market. And accordingly, we have designed our trading system. Behind every trading system, there is a philosophy. And let me tell you what is the philosophy of this particular way of stock selection. Since we are believers in trend, trend means extended movement in one direction, and but it cannot be one-way movement. Always there are retracements. These retracements add fuel to any trend. If it is an uptrend, the retracement is downward. Then after the retracement, another spate of buying comes and prices ascend to a new high, then another pullback, then another new high. This is how an uptrend occurs. The reverse is true for a downtrend. Sell off, then some pullback, then another sell off, then some pullback, then another sell off. As a result, we are getting a series of lower tops and lower bottoms. So these are trends. Now, there are various reasons why trends occur in the market, and there is a contention among the academicians. Particularly the academicians tend to believe that markets do not move in trend, right? Markets do not move in trend, and whenever there is a trend appearing in the market, they say it is the result of random selection, which is called random walk theory, RWT, random walk theory. Prices are random, they believe. Academicians, most of the academicians believe that prices are random. So there is no trend, and whenever there is a trend appearing, it is a result of randomness, and whatever profit you are earning because of that trend, you will lose it somewhere else, because in a net, markets do not move in trend. So that is what they are saying. Now, are they true? If this version is true, then there is no chance for traders or analysts like us to make any profit from the market. But this is a theoretical discussion. This discussion can be drawn on for hours, so I'm not protracting this discussion. I'm only giving you certain counter logics to this theory. Is that yes, it can be proved beyond any doubt that markets trend, but not always. Markets do not always trend. Markets sometimes trend, but when they trend, and these trends run for a long period of time, when markets trend, then there is enough opportunity for any technical analyst or any statistical analyst to identify the trend and then take advantage of that trend. If it were not the case, then there were no point in following the trend. Most of the time, markets do not trend, and markets truly move in a random fashion. But when they trend, when they show trendliness, then that trend gives us a profit opportunity, because that kind of trend runs for a very long time, and that is the nature of the trend. In some other webinar, I will give an explanation why trends run for a long period of time, and so long that even after identification, you have enough time left to take profit from that. But if we initially say why trends occur, the reason comes from behavioral finance, right? Behavioral finance can explain why trends occur and why they will continue to occur in any time frame, be it in hourly chart, be in second chart, be in monthly or hourly chart, whatever time frame. There will be trends. Trends occur because of many misconceptions, because of many inefficiencies that occur in price, and over a long period of time these inefficiencies get rectified and prices find their new value. And when prices find their new value, then the trend expires, and this is how the market goes. Trend means inefficiency, and these inefficiencies will give us the opportunities to make profit. Whenever there is inefficiency in the system, that is our profit opportunity. If a system is extremely efficient, then we cannot earn profit from a very efficient system. That is the general logic, and I can tell you why trends occur from various perspectives of behavioral finance. I can tell you here, but I will encourage you to do your own research, do your own studies in the field of behavioral finance, so that you can for yourself find out why trends occur and why they will continue to occur in future in every time frame. So that is the counter logic against random walk theory, or efficient market hypothesis, EMH, efficient market hypothesis. In a nutshell, we believe in trend. We believe prices will continue to move in a certain direction for a long time, and that will give us the opportunity to earn profit. Having said that, here in this session of our webinar, we will try to exploit some principles to take advantage of the primary and intermediate trends. Let us dive into the stock selection procedure, right? We are going to use the conception of relative strength. What is relative strength? Relative strength is not exactly as a relative strength index, right? RSI, what we are commonly calling a certain momentum indicator. We are not talking about RSI. We are talking about relative strength. What is the difference? Relative strength index, RSI, is actually an indicator that compares the strength of a particular stock with itself 14 periods ago, right? 14 periods ago, how strong was that stock, and today how strong is the stock? That measure is done by RSI. We are right now not talking about RSI. Our stock selection is based on relative strength. Relative strength means we are comparing the strength of the stock with the index itself, right? How index has fared in a given period of time, and how this stock has fared in a given period of time, in the same period of time, right? If the stock that we are investigating has given greater returns as compared to index, you can take it as sectoral index, or you can take it the index of the overall market, which is Nifty. That is called relative strength. And if we filter all the stocks in NSE or BSE, whatever, and then we can rearrange the stocks in the descending order of their relative strength, descending order, okay? Descending order of their relative strength, then we will get at the top the strongest performer of that given period. The strongest performer of the strongest performing stock of that given period, right? And there is a high probability that this strongest performing stock will be in an uptrend. Now let us do this in our own software. In our own software, we use generally Metastock or AmiBroker. Right now, I will be doing this on Metastock to find out which stocks have given us the greatest return in the past, say, a particular session. I generally use 22 trading sessions. 22 means, why 22? 22 trading sessions actually represent 1 month. In 1 month, there are approximately 22 trading sessions. So right now, I'm finding out what are the stocks that has given greatest return in the past 22 trading sessions. So I have written here some explorations. These explorations are written by me. You can also write it for yourself. A little bit of Metastock programming is knowledge of Metastock programming language is required for that. Now this is the programming that I have written here. ROC means rate of change. Rate of change of what? The closing price, ROC within bracket C, comma 22, comma percentage, bracket close. C means closing. Whatever we are finding here is based on closing price. 22 means we are using 22 days return, closing price 22 days ago and closing price today, and percentage means we are considering this in terms of percentage returns. And this is the filter that we are using. All stocks greater than one rupee will be selected, and when all these stocks, actually this filter will accept all stocks. All stocks are trading above 1 rupee. This is actually a filter to get all the stocks, and then we will arrange these stocks according to their relative strength, which I have written here with the ROC function, rate of change, right? Now I am running this exploration on my database, and here I am using not all the stocks in NSE. There are some 2000 stocks or 1900 stocks in NSE. I am not using all these stocks. Here I am using only the 200 stocks in the index of Nifty 200, right? I'm using Nifty 200 because why I'm using Nifty 200? Because I also want to participate in the mid cap stocks that show generally larger volatility than the large caps, and that is why I have chosen this. You can also select Nifty 500 stocks that will give you a bigger universe. But most good quality stocks with good acceptable level of liquidity are contained in Nifty 200. So this is the index that I prefer, and this is the universe where I run my exploration to. So here is the report, and here we go. So I have selected all these stocks according to their strength, according to their returns of past 22 days. So right now I want to open a few stocks from this universe. Now these are the stocks that have given exceptional returns, or I should say the largest returns, greatest returns in the past 22 days. And in the decreasing order, their names are Jubilant Life Science, Emphasis PFL, Mindtree, Tech Mahindra, ABB, Biocon, TCS, Infosys, Indiabulls, Housing Finance, JSW Steel. So these are the stocks that has generated greatest return over the past 22 days, and these are the stocks that we will like to trade from the long side, but not right now, not immediately, right? This is only our first screen. We are going to use another two screens. This is only the first screen where we are trying to find out the uptrending stocks, and these are the uptrending stocks. These have shown greatest momentum, greatest strength over the past 22 days, and they have outperformed Nifty by a large margin. Let us find out and let us open their charts. One thing here I can tell you is that since we have assumed or we have decided the market is in bull phase, that's why we are looking for stocks they have outperformed Nifty to the upside. They have gained more than the Nifty has gained. If we had decided that market were in a downtrend, then we would have done the opposite. We would have looked for stocks those had fallen more than Nifty, and we would have looking for opportunities to trade those stocks from the short side. Now, having said that, these are the stocks that has come to our screener, and we are investigating these stocks to check whether we can trade these stocks going ahead, right? So this is the first chart, JSW Steel. As you can see, JSW Steel has closed at a new lifetime high yesterday, right? But Nifty is still some 200 points below its lifetime high, thanks to the weakness that we saw this week. But JSW Steel actually closed at its lifetime high. So this is a clear indication that this particular stock is an outperformer of Nifty. And we found this stock from this selection process, from this meta stock exploration with this kind of programming that we had done, right? Okay, so JSW Steel, we keep a note of JSW Steel. Then what is the next stock? Indiabulls Housing Finance. The chart is not as good. Infosys, right? Infosys. As you can see, the chart is extremely upward trending, long-term bull market. So there is not much to be said. TCS is equally uptrending stock, if not more. The chart is extremely strong. So these are the stocks. I'm not going into all the stocks. These are the stocks that have outperformed Nifty in the long run. And this we will keep a note that JSW Steel, Infosys, these are in an uptrend, and we would like to trade these stocks going forward. What is the next step? In the next step, we can do two things. We can buy right now immediately, not looking at other parameters. There is a risk associated here, but there is also a possibility of greater profit because the stock may continue to go from here, continue to move higher from here. That is a choice we have to make. That is a decision we have to take. Should we buy it right now? Yes, you can do. You can buy it. You can buy all the stocks right now. But maybe this will be more risky because right now the volatility is higher, right? The volatility is extremely higher. The volatility is an important parameter. It is best to avoid high volatility entry, right? During high volatility, there is bigger chance of profit, but there is also bigger chance of loss. The risk is also bigger. So we will it is our attempt to avoid high volatility entry. That is why we will not buy these stocks right now. We will wait for a pullback, and that is our second screen, the pullback. Say for example, let me open the chart of JSW Steel. This is the chart of JSW Steel, right? Now, what do I mean by pullback? You can do several things. I use volatility based charts to find out the pullbacks. You can do any other things, but this is easy to use oscillator and also easy to interpret. That stochastic, you can use here 7 and 3 period stochastic. %K is 7 and % is 3. I generally use this stochastic time frame to find out short-term weakness in a long-term strength. In a long-term uptrending stock, I need to find short-term weakness. That is what is pullback. And this, look at this chart. These form of things where I'm putting my vertical lines here. Here, look at these vertical lines. These vertical lines are where stochastic actually dipped below 50 and then pulled up higher. In these instances, only here on this particular day, 17th of August, the pullback occurred and ended above the 50-day moving average. So that gives us another clue that when the prices are staying above the 50-day moving average and the trend is high, it is outperforming the Nifty, and the stochastic is dipped below its halfway mark, below the mark of 50, and reversing upwards. That is our second and third screen qualifying. Second screen was the pullback. I must tell you, we just have to increase the odds that the uptrend is likely to resume. And for that to happen, we have to see that the pullback, the little pullback that is occurring and that is being spotted by stochastic dipping below 50, that pullback is actually reversing. That pullback is actually ending. And the stock is starting to rise, maybe trading above previous day's high. Or maybe for 2 consecutive days it has stayed above previous day's low. So these are the characteristics that will give us stocks. Those are in uptrend, but those are in uptrend, and those that have outperformed Nifty over a longer period of time, and those are rightly in pullback phase, and the pullback is ending, and the overall bull market or overall primary uptrend is resumed. So these are the building blocks. These are the beginning conceptions, beginning philosophy to find out stocks in a bull market. The converse is the reverse is always true for a bear market. In a bear market, we will prefer to see stocks those are in extended downtrends. Those have underperformed Nifty. Then there is a pullback. In those cases, the stochastic will be above the 50-day mark, but prices will be below the 50-day moving average, and then stochastic is pulling down. So that will be the three screens of stock selection of any bull market or any bear market. We will have our stocks, we will have our list of stocks, but is it right to buy immediately? No. Why not? Because volatility is high at that point. Higher volatility means higher profit potential at higher risk. We will do better if we reduce the risk a bit, right? So for that purpose, the second and third screens are there. And this is how we tend to select stocks for our trading purpose. But this is not the most important thing. As I told you at the beginning of the webinar, the most important parameter is risk management. Just a proper stock selection will increase the odds in your favor that the stock may continue to go forward in your intended direction, but that will not give you any form of guarantee. There is no guarantee. So risk management is of paramount importance. You have to give a proper stop loss. You have to use a profit target, which is at least 2 times, if not 3 times minimum. There is also a philosophy of not to work with any profit target, and that is basically a debate. Should we follow profit target, or should we leave our positions open for bigger profits, and in the process we are ending up taking bigger risk? So this is a topic that requires elaborate discussion. Maybe we will do this in a later session in some future webinar. Right now I can tell you that so far in my experience, I have not seen any formidable advantage in either process. Both processes are equivalent. If you do your trades by following profit targets, then many a times you will get profits, and after giving you profit, markets will retrace back, and that will give you a satisfaction that working with profit target is good enough. It is advantageous. But in the long run, what will happen? 1 or 2 trends will be there, and where after your profit targets are achieved, the prices will continue to go in that direction, and it will give you some huge profit, but you were not there to take that profit because you had already exited at your target, and that compensates for all the profits that this system had missed earlier because it was not trading with a profit target. So in the long run, I have seen that the only the distribution of profits and losses are different for these two kinds of logics. You can work with a profit target or you can work with no profit target. In the long run, the profit loss distribution is different. With profit targets, you will have less or smaller profits, but more frequent profits. Without profit targets, you will have less number of profitable trades, but whatever profitable trades you will get, these profits will be big, huge profits. But net, in a net way, both systems will give you almost equal profit after, say, 50 trades or 100 trades. Say for one, after trading 1 year or 2 years, I have not seen much of difference in the two approaches. So it is your choice. I'm leaving it up to you whether you will trade this system with a profit target or you will prefer to keep your profits open. So that is a separate issue. We will take this call later. But right now, my objective was to give you a general perspective of how stocks can be selected in any market condition, whether it is bullish or it is bearish. But this decision is important. You have to take this decision prior. Is the market bullish? Overall market, that is what I'm talking about. If the overall market is bullish, then you will take only long trades. You will not take short trades. If the market is bearish, you will take only short trades, not the other way up. So that is what is most important. If the general direction of the market is right, then your chances increase of getting profits. So that's how things are done. That's how we do things. There are definitely other ways of doing things, and I'd like to look how you people do your stock selection. You can give your comments on our YouTube channel, and if there is any query, you can post it there. I'll be very happy to reply to your queries. And I hope you enjoyed this session. I'm signing off right now. See you next week. Thank you and goodbye.